Mark, you talked about it yesterday, and it seems like it's happening. We're starting to see maybe a bid coming back into the bond market. Sustainable?
Short term, yes. I think we had enough of a sell-off for the last couple of weeks, given that most of the catalysts aren't new. They're just things are getting incrementally worse. And these are long-run stories. As you know, my structural view is that we'll see much higher long-end yields next year or around the world, or even later this year. I just think that it doesn't go in a straight line, and it requires kind of a shock to kind of get a move sustainably further than we got over the past week, because there are long-term income buyers out there, and they will kind of go into these dips. So once you started seeing that feedback into the equity market, that's a catalyst for people to kind of go, okay, right, it's time for me to put some more money into bonds at the margin. That's not a long-term strategy, but it does work for the short term.
If we have pressure off of bonds, does that mean we can buy the dip in equities and kind of move on with a summer vibe again?
Yeah, I don't see any reason to be particularly bearish. I think that the flip side of that is that who's going to rush to buy the dip when you're on holidays this week and there's low liquidity? So I don't think the dip gets bought as quickly. So I can see us, having a little bit more weakness in the days ahead. But it shouldn't be any reason to panic. I just don't see any kind of major negative catalyst out there. The big pictures around the world are, we still have massive AI capex. We still have wonderful company earnings. We still have massive both private sector expenditure from the AI capex and, of course, the fiscal side from governments. Growth is fine. And you know what? Yields are going higher, but they're still quite low. Financial conditions are still super easy. We're burning off some of that excess liquidity, but there's a lot of excess liquidity. The world is still wonderfully bullish stocks, and that's been the case for the last more than a year. There was a break when we had what happened, the Middle East situation, when we had the attack in Iran, and that was a real worry that could get very, very bad. It turned out it didn't get too bad. And so we go back to the underlying fundamentals are quite positive for as long as the AI capex bubble is in the inflation stage. And at the moment, it is still in the inflation stage. When that stops, it'll get messy, but it's not yet.
And Mark, that liquidity, is it enough to absorb the issuance, the debt issuance, the equity issuance, the sovereign issuance?
Yeah, look, we're starting to see higher spreads on the AI side. Correctly so. I mean, they were super low, and we're starting to, these are people who are taking on a massive amount of debt over the last year or so. So we've had a big move in markets, but I'm not seeing any kind of panic in credit markets yet. I am worried, and again, this goes into the higher yield story longer term. I'm worried that we're seeing crowding out, and I think that the pressure from the AI debt funding on treasuries, I think, is slightly more problematic than the higher yields on what's happening to the AI space. So I guess the short answer, yeah, it's fine. We can absorb it. There's enough liquidity. Longer term, it might be a risk.